Good morning. This is Dylan Jovine with Behind the Markets. Happy Thursday. Today is Thursday, July 24th. What a great day to be alive. What a gift it is to be alive today. Anyway, today I wanted to talk about the market. The market's been going higher pretty much every day, a couple hundred points a day. It's just been marching higher. I always imagine the market moving up like a train, like chugga, 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 just going higher. I always love that. You're in a nice, strong market. And there's a lot of cause for optimism. This big, beautiful bill, despite some of the negatives of it, which I've talked about, it's also very positive. I was listening to AT&T's earnings report. Stanky's running that company. He's doing a great job over there. And he's saying because of the tax incentives in the big, beautiful bill, we are going to invest a lot more sooner in America building out our fiber infrastructure. We're also going to put money in retirement to bring up our funding from 90% to 95%. That's a very positive sign. It's a terrific sign. And I'm very optimistic about that. And the president announced the trade deals. We'll get more specifics on that. Still, a lot of folks have asked me, what do you think about the stock market? Do you think the market's overvalued? And I'll tell you something. They once asked Warren Buffett the best indicator of stock market value that he's ever used. And he said basically market cap to GDP, the market cap of stocks to total gross domestic product. And we have basically about $30 trillion economy, $30 trillion a year. So basically what he's saying is that the market cap of all stocks in relation to our total GDP, that $30 trillion, is what he said is the single best indicator of whether a market's overvalued or undervalued. We call it the Buffett Indicator, and this has been a very big thing on Wall Street. I remember I learned it when I was studying for the CFA. I was in the CFA class, and I was talking to this girl, this super brain, who worked for Carl Icahn's office, and she's the first one who taught me about this 25, 30 years ago. I remember saying, wow, and I've watched it ever since. The Buffett Indicator, if you actually look back, it's like spot on as a general indicator. It doesn't tell you when something is going to go down. Doesn't tell you when. What it does is it tells you if something's overvalued or undervalued. It doesn't tell you the exact date a market's going to crash. It's not that kind of thing. It just tells you in a general way whether things are overvalued or undervalued. And things, believe me, can stay overvalued or undervalued for years at a time. I have seen it firsthand. That's why I don't short stocks. I remember the chairman of Lowe's shorting stocks in the 90s. The dot-com boom, he started shorting stocks in 97, 98, 99. And he was right. The market was overvalued. And he lost billions of dollars, even though he was right, because he was right on the fact that they were overvalued, wrong on the timing. So this is one reason I never short stocks. Anyway, where are we now with market valuations with the Buffett Indicator? How concerned should you be? I'll tell you something. Right now, the U.S. economy, again, is at about $30 trillion, and the Buffett Indicator is at a record 210%. It's 210% above that. So he's saying basically the stock market has a complete market value of about $63 trillion, which is 200% above GDP. Now, what Buffett would say is that a stock market is cheap when it's about 70% of GDP. So basically, if GDP is 30 trillion, we'd see a stock market at about 26 trillion. That would be cheap. So right now we have the Buffett Indicator is significantly overvalued. And what that means is that basically the last time it was this overvalued, this is the highest it's ever been. It was overvalued like this in 2007, right before the real estate crash. 2009 crash. It was also overvalued like this during the dot-com bubble, but this is still a high. Look, as you go through life as an investor, you're going to find that there are a lot of people. Groupthink is a very big deal. It is so seductive to say to yourself, oh, this market's going higher, this market's going higher. The discipline is to be patient, to be able to sit with cash and wait for opportunities, not to get caught up in the euphoria. That is a hard thing to do. I'm not saying I'm not invested in the stock. I'm going to sit there sucking my thumb with a bunch of cash waiting for the market to crash. That's just stupid. But I am sitting on cash, and I do wait to pick my spots, and I don't really get caught up in the euphoria, which is very difficult. Look, at the highest level, this game is a mental game. Investing is a competition against yourself. It's based on your ability to keep your cool, to keep things in perspective, to not get emotional, to not get caught up with the hype. That's what good investing is all about. Indicators like this are very helpful because it really shows you how euphoric people are and how untethered to reality that is. Now, does that mean we're not going to pick our spots and take our wins and play the game? Of course we're going to play the game. Again, we're not in the sitting at home ducking our thumbs business. We're out there to play the game, but we're not going to play stupidly. We're going to swing for pitches that are in our strike zone. We're not going to swing for things in the dirt. I'm not going to reach out and swing high or swing low, swing into the dirt. Let's just stay focused on things that are in our strike zones and just keep hitting for base hits. But in a market like this, you're going to see a lot more base hits than home runs because the home runs have been extracted out of the market for the most part. But we're going to keep looking for them. And we have found some. Look at Break the Wealth. We're just killing it. So anyway, this is what I wanted to discuss today. You can tell this is a real Wall Street term. On Wall Street, we talked about the Buffett Indicator for years, and we started using it in our marketing and our advertising. And now I see everybody really talking about the Buffett Indicator basically all around. So I figured I'd just talk about it here so you get a little valuation check on what the market looks like here. But we are now significantly overvalued at the highest level we've been in our history. And usually, again, it doesn't tell you when the market's going down. It just tells you, red light, warning, this is overvalued, warning, system's overheating. It's one of those kinds of things. But it doesn't tell you when the engine's going to fall off. Anyway, that's all I have. Have a wonderful Thursday. I'll speak to you tomorrow.